$10 billion. That's the estimated capital vaporized from a once dominant crypto firm, now filing for Chapter 11, pushing shockwaves across the entire market today, 23/07/2026. This isn't just about a company collapsing. It's a seismic event reshaping the landscape for everyone involved in Web3 and decentralized finance. What most news channels are missing, however, is the flip side of this coin. The immense, ground floor opportunities emerging for those ready to pivot. While panic sells dominate, smart money is repositioning, identifying the distressed assets and new infrastructure plays that will define the next bull run. This isn't a time to sit on the sidelines. It's a critical moment to understand where the real value is shifting and how you can capitalize on it right now. What exactly happened? This firm, which became a household name during the last bull market, soared on the back of a proprietary token that promised stable returns and high yields. The collapse wasn't sudden. It was a slow burn, fueled by unsustainable leverage and a lack of transparent risk management. Their token, once trading at peak valuations, suffered a brutal de-pegging event, wiping out investor confidence and triggering a cascade of liquidations. We've seen this playbook before, but the scale this time is different, impacting not just individual investors, but also institutional players and other interconnected platforms. The ripple effect extends to DeFi protocols and even some traditional fintech firms that had exposure, highlighting the interconnectedness of modern finance. This isn't just a crypto story. It's a testament to the risks of unchecked growth and the critical need for sound financial strategy in any venture, digital or otherwise. Understanding these core mechanics is crucial for anyone building wealth. The data tells a stark story, but also hints at resilience. While the firm's native token plunged over 90% in a single week, overall market cap for established blue-chip cryptos saw only a temporary dip before recovering. This suggests a flight to quality, not a systemic collapse of the entire asset class. We're seeing liquidation volumes on major exchanges spike to levels not witnessed since the 2022 downturn, signaling a massive transfer of assets from weak hands to strong. On-chain analytics reveal whales are actively accumulating at these lower price points, a clear indicator of long-term bullish sentiment despite the current turmoil. Early signals from YC Demo Day pitches indicate a surge in new DeFi projects focused on transparent lending and real-world asset tokenization, pivoting from the previous era's risky yield farming. This isn't just speculation. It's a documented shift in capital and innovation towards more robust, regulated, and sustainable models. The smart money is not leaving crypto. It's simply moving to better, more defensible positions. Here's what nobody mentions in the mainstream panic. These market corrections aren't death knells. They're essential purges. They create fertile ground for the next wave of innovation and new empires, much like the dot-com bust birthed Amazon. This crypto downturn is no different, flushing out unsustainable leverage and flawed models, clearing the path for genuinely valuable, resilient projects. The real opportunity isn't just in buying the dip. It's in building the infrastructure, the tools, and the services that thrive in this new, more mature market. So, what's your concrete next step today? Research real-world asset tokenization, RWA. This isn't just a buzzword, it's a practical business model connecting real assets to blockchain. Think about how a Shopify store owner could tokenize future invoices for immediate capital, or how a freelancer might fractionalize future earnings. This is where the next wave of sustainable wealth is being created, moving beyond speculative tokens. Understanding RWA is a critical skill for identifying where the real defensible value is being built. Hit subscribe if you're ready to build it with me. Leading analysts aren't just reacting to the market dip, they're dissecting the underlying architecture of digital finance. Many economists, especially those at institutions like Bloomberg and WSJ, are now highlighting the critical need for robust risk management tools. They're pointing out how this event underscores the maturity gap between nascent crypto ventures and established financial systems. This opens a massive lane for services specializing in automated compliance solutions and real-time auditing, a field ripe for SaaS innovation. Think about the demand for systems that can flag over-leveraged positions before they spiral, a multi-billion-dollar problem begging for a tech solution. Beyond our borders, this recent collapse isn't just news, it's a catalyst. Developed economies are accelerating discussions on central bank digital currencies, CBDCs, and cross-border payment rails, aiming for stability. Meanwhile, emerging markets, often more agile, are seeing this as an opportunity to leapfrog traditional finance by building resilient digital asset infrastructures from scratch. Entrepreneurs who can navigate diverse regulatory landscapes and offer localized digital payment solutions or micro-lending platforms in these regions are setting themselves up for significant growth. Geo-arbitrage in the digital realm just got a fresh tailwind. Looking back, the closest parallel isn't a single event, but a pattern. Every major technological revolution has its dot-com bust moment. Think the early internet, where countless companies with flashy websites but no business model crashed. Yet from that rubble, giants like Amazon and Google emerged. This crypto event mirrors that culling process. It's a shakeout, removing unsustainable projects and paving the way for those with real utility and solid fundamentals. History shows us the biggest fortunes are often made by those who invest or build during these periods of market reset, not when everyone else is blindly chasing hype. FTX's collapse, with over $8 billion in assets lost, serves as a stark reminder of the risks involved. When a crypto firm falters, most people see only widespread loss, but there are always unexpected beneficiaries. Compliant decentralized finance, DeFi protocols, with transparent on-chain governance and audited smart contracts are gaining immense trust as alternatives. Traditional finance firms, who maintained a cautious distance, now see a clearer path to integrate digital assets on their terms, leveraging their established regulatory expertise. The biggest winners, though, those who built tools for shorting volatile assets or created educational content explaining market mechanics. They're profiting from both the downside and the surging demand for financial literacy.